welcome everyone on good evening to one and all. I welcome everyone on behalf of WIRC to today's WOW series on CSR provisions, accounting and taxation by CH Armi Shah. So before embarking on today's session, may I request to play ICI motto.
य एष सुप्तेषु जागृति य एष सुप्तेषु जागृति कामं 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 कामपुरुषो पुरुषो निर्विमाणः निर्विमाणः तदेव शुक्रं तदेव शुक्रदब्रह्मा तदब्रह्मा तदेवामृतमुच्यते तस्मिन् लोकः शतः सर्वे तदूनात्यपि कश्चन एतद्वैता 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 एतद्वैता.
Thank you. Under the dynamic and visionary chairmanship of CA Ketan Sayyas sir at WIRC, we have planned n number of events and programs. Just to name a few, like Bhagyodaya is the brainchild of our chairman sir, in which all the area-wise subjects are taken, and we have all the series in which small and medium practitioners are given, uh, are trained like how to scale up the practice. Like we had a session on FEMA, international taxation, RERA, etc., so on and so forth. Apart from this, I have been given a chairmanship of internal audit, in which we had one basic program, and upcoming is internal audit conclave, which is held on 12th and 13th of September. The details of which are there on website. And apart from this, we have many other programs such as help desk, direct tax, indirect tax, Nyaya Setu, which of course our chairman sir will help. So with this, may I request our chairman sir, CA Ketan Sayyas sir, to give us opening remarks. Over to you, sir. Thank you.
Thank you, Jinal Madam, Secretary, Western India Regional Council, learned speaker for the day, Charmi Madam, our coordinator, Dwani Karya Madam, and all our participants. A very good evening to all of you. It's very honor and privilege to talk to all of you. And today we have fantastic session on CSR. I think this is need of our. We must learn the provisions of CSR, and ICAI WIRC has started one initiative for CSR, wherein we want to examine the good projects, and we will take those projects to the corporate and request them to do a CSR through this type of validated, trust validated projects, which the WIRC CSR committee will validate. Upon the programs, we have the biggest sub-regional conference of Gujarat happening on 2nd and 3rd of August. Request all of you to register and take advantage of the fantastic session lined up by the team Gujarat. I think, all areas are very well covered, be it GST, be it AI, be it income tax, be it audit and assurance. And one such seminar, one such conference where each practitioner will gain, and there will be a good fellowship because people from across region will travel to Rajkot, and that is going to be the interesting seminar. The regional conference of WIRC, the biggest program, is happening on 19th and 20th December at GEO World Convention Center. The program worth of 10,000 is just launched for 4,500. Requesting all of you to take advantage of that. First time ever in the history of Western India Regional Council, we have introduced annual membership concept. By paying for a woman member, it is 9,000, for seniors 9,000, for all other chartered accountant 10,000 plus GST. If we pay, we have access to all online programs for the 9 month, all physical program which are happening in ICA Tower BKC, and rest of the program there will be discount of 10%. So I request all of you to take advantage of this entire annual membership concept for 9 months. Once you do the registration and you have access to all the program which are happening of WRC, the calculation which we did, almost in 9 months we will be offering program worth of 40,000 rupees. So it is at hardly a discounted rate of 25% being offered to all the members. So requesting all of you to participate in annual membership scheme. I'm sure Charmi will lead this session in a very, very fruitful manner, and it is going to be very interesting. Charmi, thank you so much on behalf of Western India Regional Council for sparing your valuable time and spending time for the WOW series. Thank you so much. Over to you, Jinal Madam.
Thank you, Chairman Sir. As rightly said by Chairman Sir, we are looking forward to have insightful session from CA Chami Shah. And with this, may I request CA Dhwani Karya, our today's coordinator, to introduce CA Chami Shah.
Thank you so much, sir. Thank you so much, Jinalji. Most first and foremost, heartiest welcome to you, CH Armisha, for taking this session today. Friends, Ms. Charmisha is our fellow member of the CA Council and has also taken up the course of Social Auditor from NISM. And she has also taken up the certificate course on PR review and BSRSR. And her areas of expertise are tax related matters, social audit, company law and ROC, PR reviews of firm, and corporate social responsibility, amongst other compliances. She has also taken up a lot of seminars on ICDS and income tax at different study circles of WIRC and WISAC branch of ICAI, and she's also a regular speaker of the Chamber of Tax Consultants. She's a regular faculty at the CSR certificate course at ICAI and has also given us various articles on CSR, social audit, and income tax in various journals published by the ICAI. She has also many feathers on her cap by various other achievements, like she's co-opted member of the Professional Development Committee of the WIRC of ICAI. She's also been a special invitee of the CMIB Committee of the ICAI. And she has also been a member of the Women Member Empowerment Committee of ICAI in the past. Also, amongst all this, she has also co-authored various books, including the Technical Guide on Accounting of CSR Funds by Third Party, which is a publication by the ICAI. She has also given us a handbook on certification of Form CSR1 by ICAI. She has also co-authored the Handbook of Audit on CSR Activities and Technical Guide on Accounting for Expenditure on CSR Act, which is published by ICAI, and she's also co-authored the Handbook on Ethics for ICAI. Amongst all this and many, many other things, I welcome you once again, CH Armisha, and we look forward to have a very insightful session today. I request you to now take over. Thank you.
Thank you, Dhwani, for such kind words for introduction. Thank you, Chairman Sir and Secretary Ma'am, for your presence and giving me chance to give some few my insights on this topic. So before I start with my session, I would share my screen. So very good evening to one and all present here, and hope you all are in pink of your health and doing well, and mostly importantly, very safe and having a good tax season which is approaching soon. So to start with our CSR thing, let us first look at this proverb which says, when the wind blows, there are those that build walls, and then there are those that build windmills. What does this mean? This means that the adage of building windmills in the middle of winds of change is a beautiful illustration of how you can harness the flow of life into something positive and create by being open rather than being resistant to it. So, by being open, you get to see the hidden blessings in every situation and hence use it to your advantage. So, you can turn into an alchemist who uses something negative into create something positive and fruitful. In the same fashion, our companies who invest in CSR to manage their risk, recruit employees, and bolster their brand in the eyes of investors and consumer used to invest in CSR. So initially, only it was a social obligation, but after the amendments which have taken place in the recent past, it has taken into financial and penalties are levied to the companies. So now companies have mandatory their CSR into their investment projects. So mostly companies are increasingly ramping up their focus on social responsibility, whether it campaigning women's rights or protecting the environment or attempting to liberate poverty on local, national, or global level. So, from an optics perspective, socially responsible companies project more attractive images to both consumer and shareholders alike, which serves to positively affect their bottom lines. So before going on to what amendments are coming through last few years, let's look at the flow of CSR and its evolution in India. So corporate social responsibility was first time introduced as a statutory obligation for companies by the way of Companies Act 2013 under section 135. So thereafter the company's rules were notified on 27th February 2014, which are now called as CSR Policy Rule 2014, to lay down the specification and procedures to be followed by the company while discharging their CSR obligations. So the Companies Amendment Act of 2019 and 2020 resulted in various major changes in CSR provisions under Section 135 of the Companies Act. So to provide for the notified changes, the MCA had released the draft companies amendment rule in March 2020, which were called the draft rules. So that invited public comments, and based on that public comments, on 22nd January 2021, the MCA finally issued the company's amendment rules, which are now called the new rules, and now every company has to follow this new rules, giving effect to the changes introduced in CSR by the Companies Amendment Act 2019 and 2020. So the provision shall not affect the CSR projects or program approved prior to 1/4/2021. So these rules are only applicable for all the projects which are approved after 1st April 2021. So we do not require to see how legislation in India took place for Section 135 in the Companies Act, but just let's once look at how it started and ended right now from 2013. So the first, let's see the enactment of Companies Act 2013, which gave way to CSR in Companies Act, which is predominantly and corporate governance issues, and now it was important step that CSR found way in Companies Act. So India was the first country at that time to do so. So of course, section 135, which was made part of it. Later on, there were amendments that happened to it, but the key that happened was constitution of high level committee in 2015 for improved monitoring of implement of CSR policies. And of course, that year there was inclusion of penalty clause. Unspent balance of CSR fund is to be carried forward. Unspent balance to be transferred to one of the fund in the Schedule 7. Board CSR committee to be responsible for due diligence of implementing partner. This all were introduced in 2015. Then comes in 2018, another high-level committee was set up. They included the concept of carry forward of unspent balance for the period of 3 to 5 years, imposing monetary penalty for non-compliance, mandatory impact assessment, strengthening the report of CSR, registration of impact assessment with the MCA, so impact agencies. Additionally, 5% administration expenses for companies undertaking need and impact assessment, etc. And these all things were recommended by the high commission level. Then comes 2019, where the Companies Amendment Act was included. Immediate preceding financial year for eligibility under Section 135 was notified. The things which were not notified were transfer of unspent amount to fund mentioned in Schedule 7, carry forward of unspent amount on ongoing projects, introduction of penalty clause for non-compliance, including imprisonment. And then at last, 2020, notification were there were changes made which included in the act where carrying forward of excess spend and unspent amount relating to ongoing project. This was a welcome change and many companies wanted this change to be implemented, and this have given benefits to a very each and every company who excess spend during their year, so they get benefit in the subsequent financial year. Then comes transferring of unspent amount not relating to ongoing project into Schedule 7 fund and monetary penalties for non-compliance. So this amendment rules 2021 shall come into force on the date of its publication of the official gazette, that is 22nd January 2020, unless explicitly provided elsewhere in this notification. So we'll take this notification in brief in my subsequent slides. But till then, I'll just tell that it is coming into effect from 22nd January 2021. So while some of the amendments will actually be relevant from 1st April 2021, some of them will have immediate compliance implications. So as we all know, the basics of CSR, that CSR is applicable to the company that met specific financial criteria. So specifically companies with a net worth of 500 crores or more, a turnover of 1,000 crores or more, or a net profit of 5 crores or more during the immediate preceding financial year are required to comply with CSR provisions according to the Companies Act 2013. So these companies who come under this purview must constitute a CSR committee and spend a certain percentage, that is 2% of their profit on CSR activity. So today, first let's look at the Amendment Act. What are the changes that took place on 22nd January? Then we'll take up the accounting provisions and the auditing part. So why are these new rules significant? What are the main important 5 points that were amended? First was CSR definition was changed. They have included certain things to make CSR applicable to certain people, or they have widened the scope. The next point was shift from directional to mandatory CSR. So certain companies are now mandatory to spend their CSR expenditure. First, initially, it was directional at the discretion of the company. The third point that there is a change is registration requirement for the implementing partners. it is required, and now the implementing partners without their registration cannot accept new assignments or new projects to be implemented. And for that, they have also done registration through CSR Form 1. We will also look into this matter in brief, and we will take up these points in detail in my subsequent slides. The next change was increased rigor for internal control. And the last is focus on impact creation. First, initially only spending part was important, but now they want that if the company is spending the money, it should impact a social cause. It should impact society at large. So the impact creation is very important. Now, considering the first change, that is the change in CSR definition. So CSR is now a statutory obligation, and before it was not there. So as a result of new rules, corporate social responsibility is now defined under Section 2D to refer to the activities undertaken by a company in pursuance of its CSR obligation under Companies Act. So the amended rule further identifies the activity which do not qualify towards CSR requirement of the company. So the following activities are excluded from the list of CSR activities. The first is activities undertaken in pursuance of normal course of business of the company. So the question arises whether the employees can be, so during COVID times this was introduced, and so the questions and FAQs which were released were during the COVID times. So that time the companies who were doing their normal course, if a company was doing its normal course of manufacturing of pharmaceuticals, they were migrating their employees to their hometown also. So there were expenditure made. So that manufacturing of pharmaceutical company asked MCA whether they can migrate their employees to their hometown, because that time everyone was migrating to their hometown and no one was willing to stay at the place where they are working. So that time they claimed their expenses to migrate their employees in CSR. So the question arose whether the expenditure made on the employees to migrate to their hometown, and that amount can be granted as CSR for the companies. But many circulars and notification came out which clarified that migration of other companies' workers or other companies' employees can be claimed as CSR, but not migrating their own employees. This was coming as in the same fashion that if in the normal course of business they can help their employees to migrate, but they cannot migrate their own employees and claim CSR. So normal course may include sales, supply or goods and services. So they cannot become a part of CSR. So here, mere absence of profit motive will not take an activity out of the normal course of business. So if the company says that we do not have any profit in this material and so we are doing it as CSR, but it doesn't qualify to become a CSR activity. So however, in view of the pandemic times, the COVID pandemic times, an exception to this was created by the way of MCA notification dated 24th August 2020, allowing companies engaged in research and development activity of new vaccines, drugs, and medical devices in the normal course of business to undertake such research and development in relation to COVID-19 as their CSR obligation. But this allowance was only given for 3 financial years, that was 2021, 21-22 and 22-23. So now that exemption is revoked, and now every company has to fall in the first activity undertaken in pursuance to normal course of business of the company. So this exception was has been newly incorporated in new rules subject to certain conditions. If the company satisfies such conditions, like first, such research and development activity shall be carried out in collaboration with any other institute or organization mentioned in Schedule 7 of 9, item number 9 to the Act, including public funded institution, IITs, ICMR, that is Indian Council of Medical Research, etc. And such details of such activities shall be disclosed separately in the annual report of the CSR, included in their board's report. So this any pharmaceutical company who is into the research and development of the new vaccine has to give all details of the activity in the annual report in the board report. Then comes the second: activities undertaken by the company outside India shall not be considered as CSR except for training of Indian sports personnel representing any state or union territory at national level or India at international level. So before the amendment, it was activity outside India, not included. Now little changes, that is included with some exceptions. Coming on to the third point, contribution of any amount directly or indirectly to any political party under section 182 of the Act by the company shall not qualify as CSR. There is no change in this point, so not elaborating more. Yes, this fourth point, activities benefiting employees of the company as defined in section 2K of the Code of Wages 2019. So here, two key points that are changing here is activity benefiting employer of the company is employees under Code of Wages Act. So this is very significant change. The meaning connotation of the word employ that is now connected to Code of Wages Act. Before that it was not covered, but now it is covered in the Code of Wages Act. So for our understanding, in layman's language, the employee which are hired for reward are only taken. So moreover, the regulation itself gives definition for contractual employees. Also, that extends the definition should not include contractual employees. So coming on to the second point of employees benefiting part, initially it was talked about benefiting employees in community. It was okay. But draft rules came in March 2020 and also indicated significant benefits that talk about 25% of the benefit. So now the amendment which has come in is too specific and taken away the word significant. So that extends any benefit that goes to employees or any project which goes to the employees which actually get disallowed. And here the second point comes the word family. So initial draft which was formed in 2020 spoke about family and its benefit. So the current situation, the word family is taken away, which so that the interpretation can be if it is not benefiting employees but benefiting family, still it can be said to be CSR activity. But benefits to the employee should be avoided. So here a question comes into the mind that does it mean that the employees cannot be a beneficiary of the CSR project if done to the society at large? So for example, XYZ company, one of my client's company had made hospital beds for the society at large. So but in those beds, there is no special reservation for employees of the company. But in case they use it normally as others in the society, that does not mean that the amount spent on the employees will be reduced from CSR spend. As an organ of the society, they can take the benefit of the beds, and also the company can claim CSR activity. Coming on to the next point, activities supported by the companies on sponsorship basis for deriving marketing benefit for its product or services. So here, there were many FAQs released during that time by the MCA. So going on to the FAQs, by seeing that, let's take an example of favor marketing or sponsorship. A company was doing sponsorship. So if a sponsorship has done for the product, but not deriving benefit for its own product or services by that sponsorship, then it is called favor market. So one of my clients organization had take up a initiative of sponsorship of part of some urban city considering its environment, sustainability, hygiene perspective. They had to develop that village. So this is unlinked to their product. So such kind of one should explain CSR committee that we are not getting any benefit from such sponsorship, and so it is a CSR. Now coming on to some examples where CSR was made, but it was getting benefit to the company, and so it would be not considered by the committee as CSR activity. For example, one bank motivates customers, its own customer, to spend 5 lakh rupees on credit card. And the company said to its customer that if you spend 5 lakhs on credit card, then it would contribute 500 rupees towards the charitable activity. So the question arises, is that 5 lakh or 500 rupees that is contributed to the charity activity be considered a CSR spend? The answer would be no, because the company is getting benefit of 5 lakh rupees in turn of spending 500 rupees for charity activity. So this would not be considered as CSR activity. So then comes an example of direct sponsorship, which is benefiting the company directly. So many a times organizations are sponsored ball pens and study materials. So here we can see a direct and indirect nexus with the society, with the company's profit. So if you have sensitive analysis to conclude here that no nexus is received or no nexus to benefit the company, then only you can claim CSR, or else you will have, the company would have tough time to prove that the material or ball pens which were given to the society can be considered as CSR. So for considering an activity to be in CSR activity or no, various facts has to be seen. Like first, the facts of the project, the final output of the project, the social impact that is created by the project. The board or the committee, CSR committee, has to see what to do, because it's a total gray area. It's not a black, it's not a white. You have to understand its nexus, its various points while implementing, while getting its benefits. The importance has to be given at that time to the language in the agreement which is made between the implementing partner and the company. So the MOU has to be tested, verified to check whether this can be considered a CSR activity or not. So for example, during COVID times, COVID related awareness was done by the company. They specifically permitted a CSR activity as per circular of 12 January 21. So there can be too much marketing advantages from this too, but it was allowed at that time. The company has, for example, a company has built a water cooler everywhere and it has carved in logo on that water cooler. And that logo was used for its marketing purposes. There is a brand visibility. So just as it markets its company, does not deprive it to be recognized as CSR activity. That company can consider it as CSR activity. Just keeping a logo on the water cooler doesn't deprive it from the advantages. And the last thing comes is activity carried out for fulfillment of any other obligations under any law in force in India. Now coming on to the second thing, the change was CSR definition. So CSR definition, a new concept, ongoing project was made. So ongoing project definition, let us consider it. The term ongoing project was referred to indirectly under CSR Policy Rules 2014 and has finally been defined to mean a multi-year project undertaken by a company in fulfillment of its CSR obligation. The maximum allowed during of which is 4 years, 3 years, excluding the year of commencement as mentioned in the new rules. So the first year would be the year of commencement, and then 3 years you can continue the same project. So the definition also includes projects that were initially not approved as multi-year but are later extended beyond 1 year by the board on reasonable justification. The ongoing projects entail certain added responsibility for companies, such as requirement to monitor their implementation as per approved timelines under Rule 4.6 of the new rules. Here, the MCA had made an attempt to define ongoing project is definitely a welcome step. But ambiguity remains with respect to projects, the implementation of which goes beyond the stipulated time period of 4 years. So, as per current rules, companies may not be able to undertake such project as their CSR activities because they shall not qualify as an ongoing project, and any unspent amount in that regard shall automatically be transferred to the fund specified in Schedule 7 as required under Section 135 of the Companies Act, 135(5) of the Companies Act. So, for example, a company contributes to annual running expenses of a cancer hospital. The spending for the next year cannot be regarded as an ongoing project. So, like annual expenses comes annually, so it doesn't consider as the ongoing project. It is not ongoing project. But for example, installation of a new facility at the same hospital, if already undertaken during the year, should be regarded as ongoing project. So regarding to regard it a project as ongoing project or not going project, it is necessary that some spending must have been done or must have been spent during the year. So if there is a binding commitment on the part of the company during financial year, the fact that nothing has been spent during the year should not preclude it from ongoing status. So the essence of the retention money is rolling the expenses to the next year and claim it expense for this financial year. So target spending and not spending amount on ongoing projects should be disclosed it in the board report, the annual board report on CSR activity. Then comes administration expenses, that is administration overhead. The latest amendment introduces administration overhead as a new term, which is defined under section 2B to refer to expenses incurred by the company for general management and administration in relation to its CSR functions. So the definition explicitly excludes expenses directly incurred for designing, implementation, monitoring, and evaluation of a particular CSR project from the ambiguity of administration expenses. So as per Rule 7.1 of the draft rule, said that the board was required to ensure that administration overhead incurred in furtherance of CSR do not exceed to be 5% of the total company's CSR expenditure. So the meaning of administration overhead was, however, not specified under draft rules. Assigning a definition to the term in new rules is a very welcome step, as it gives greater clarity to the companies. So in my opinion, the government should also mention a few examples of costs that should qualify as administration overhead for better understanding of the terms, scope, and everything. So under the amendment rule 7, the board has been given the responsibility to ensure that administration overhead in relation to CSR do not exceed 5% of the total CSR expenditure of the company. So it is to be noted that draft rules propose an upper limit of the 10% for administration overhead for the companies undertaking impact assessment. But such a provision has not been directly notified in 2021 amendment. Rather, under Rule 8.3c of the new rules, the companies carrying out impact assessment have been allowed to claim 5% of the total CSR expenditure or 50 lakh rupees, whichever is less, as CSR expenditure. The third definition which underwent changes was eligible entity. As per Rule 4.1 of the company's Corporate Social Responsibility Policy Rules 2014, which was amended in 2021, the board of the company shall ensure that CSR activities are undertaken by the company itself or through third party. So this third parties are the eligible entities which are defined in the Rule 4.1 of the Sub-Rule 1 of the rules. So what all comes under eligible entities are? First, a company established under Section 8 of the Act, or a registered public trust or registered society registered under Section 12A and 80G of the Income Tax 1961, established by the company either singly or along with any other company, or a company established under Section 8 of the Act or registered trust or registered society established by central government or state government, or any entity established in the Act of Parliament or state legislation, or a company established in the Section 8 of the Act or registered public trust or a registered society registered under Section 12A and 80G of the Income Tax Act 1961, and having an established track record of at least 3 years in undertaking similar activities. So the title of the Rule 4 has been changed from CSR activity under CSR Policy Rule 14 to CSR implementation as a result of 2021 amendment. So in cases where the board of the company is not carrying out CSR activity by itself and undertakes through some third parties, till now there was no problem for identification and registration of such entities. But in such cases, presently, a company has to follow a thorough and stringent selection process so as to ensure that the organizational goal towards CSR are achieved in the most transparent, effective, and efficient manner. So, further, the company is interested in engaging third parties for implementation of CSR activity has to scout for appropriate entities on its own. So, the database of the registered implementation agency would become a handy tool for the companies looking for implementation entities. So the amendment rule 42A of the company's rule 14 makes it mandatory for every such entities and who intends to undertake any CSR activity to register itself with central government. So it is to be noted that draft rules have omitted references to registered public trust and societies for CSR implementation, which were present in the original CSR policy rule 2014. Such an omission was objected by stakeholders, and resultantly, public trust and society have now been mentioned as allowed implementing agency under new rules. So such a move is appreciated, and as it gives company a wider access and a wider range of entities to fulfill their CSR obligations. Now coming on to mandatory CSR spending. So the MCA-wide Companies Amendment Rule 2021 shifted CSR spending mandatory from voluntary. So in one of the articles said that India has equated CSR with spending part, whereas in other countries it is equated with the responsibility part. So in India, spending is main crux in CSR and not the responsibility. So first part is unspent amount relating to an ongoing project is to be transferred to unspent CSR amount and used within immediate succeeding 3 financial year in pursuance to CSR policy. So recent amendment which has changed the compliance for CSR to be spent of 2% of average profit from last 3 preceding financial year. So first, there should be a CSR liability. If the entire amount is spent, then reporting should be done in the director's report. Then comes entire amount is not spent. Then we have to consider whether it is an ongoing project or not ongoing project. If it is ongoing project, yes, then it should be deposited in unspent CSR bank account within 40 days from the end of the financial year. But in case it is not ongoing project, then the entire amount has to be transferred to government fund notified in Schedule 7 within 6 months from the end of the financial. So the Companies Amendment Act as on 22nd January 21 say that now if you're not spend your money, then you have to give it to one of the specified fund. So rule is that unspent amount of not ongoing project, then you have to deposit it into one of the Schedule 7 fund within 6 months from the end of the financial year. That is, you can say it is till September. So earlier there was not mandatory to make provision for the same, but now it is mandatory to make a provision for the unspent amount at the end of the year. So either you spend it or you don't spend it. You have to make provision of the same. It is not that you can spend it later, you have to transfer it within 6 months from end of the financial year. Or in case it is ongoing project, it has to be transferred to a separate bank account within 30 days from the financial year, called as CSR unspent. So now question arises for fund which does not spend up to March 2020. So that time the case was the amendment was released on 21st March or January. So the question arises that now what shall we do in this year? So there were two ways where the company dealt in during those times. So where it was unspent, they disclosed it, but no provision was made and gave reasons in the disclosures in the board report. But the other way was they made provisions in the book as unspent CSR account. And now, if this amount is not used by March 2021, this had to be transferred to Schedule 7. So it can be said that this amount doesn't belong to this year, so should be deposited in the bank depending on ongoing and not ongoing project. So the board shall still explain the reason for not spending in their report. This remains, for example, if the project is not finished as it is ongoing, so the company parks their money in the project, then identifies the amount required to be done in the project for not indefinite period, but for maximum 3 years. So for that, you have to identify the outlay required for ongoing projects at the start of the first year. That is first part. The second part is the amount not retained has to be transferred to National Unspent Fund within 6 months from the end of the financial year. So if it is not constituted, then the amount has to go to fund schedule 7. So we do not actually have total 6 months to decide whether we are retaining the amount or not. Why? Because you just have to disclose it in the board report, and board report has to be given. Most board reports are made within 45 days of the end of the financial year, and then the board meeting takes place. So you only have 45 days to decide that whether you will park these funds into the ongoing project or not ongoing project, and based on that you have to transfer the unspent amount. So therefore, effectively, the complete analysis will only take 2 months from the end of the financial year. So effectively, in my view, you only have 1.5 year from the end of financial year to kept it as retention or transfer the amount to Schedule 7. We have more 6 months to transfer the amount, but the decision has to be taken at first month itself. So we only have 2 months to analyze and retain the amount. There should be action plan made by the CSR committee, and CSR committee should identify and make disclosure in the board. Then comes amount transfer to unspent CSR amount remaining unspent at the end of immediate succeeding 3 financial year to be transferred to government fund. We have already discussed it. Unspent amount not relating to ongoing project to be transferred to government fund notified in Schedule 7. Then comes ongoing ongoing project defined as multi-year project not exceeding 3 years, excluding the financial year in which it was commenced. Board may extend duration of the project to make it as ongoing project. So ongoing project defined as multi-year project we have already seen. The board may extend duration of the project to make it an ongoing project. So board cannot approve for more years. So you can max to max you can approve for 1 plus 3 years, and over the period you can get approval for more 1 year or 1 plus 3 years. So maximum you have only 4 years for ongoing project. So companies may think there is less visibility, only we will get 4 years for a project to be delegated. But that's not the case. We have to create a provision for 4 years. An ongoing project amount which is unspent to be dropped in scheduled bank in the separate account, which can do for capital expenditure also. So if there is no ongoing project, then you have to transfer it to the schedule notified fund in Schedule 7. So moving from directional to mandatory, now all would love to have ongoing projects because they want to take credit for their work and not just deposit the amount in Schedule 7. The third point is board to monitor implementation of ongoing project and shall be competent to make modification if required. So, for example, if the company has to spend 10 crore rupees and spend 15 crores, the excess 5 crore can be carried forward and set off against the next preceding years. So set off excess amount, you can use the excess amount spent for next 3 years, but after fulfilling two conditions, that is first, the board resolution has to be passed, and second, it shall not include any surplus arising for CSR projects. So surplus arising cannot be claimed as business profit, and it can be kept in unspent account. So excess spending in any year is a matter of fact, and that is not the same thing that requires a board's decision. However, the decision to adjust all totally depends on the board. Then comes capital asset. Under the new rules, the company is further allowed to spend the CSR amount for the creation or acquisition of the capital asset held by first a company established under Section 8 of the Act, registered public trust or registered society having charitable objects and CSR registration number. Second, beneficiary of the said CSR project in the form of self-help groups, collectives, entities, or and the third company comes a public authority. So under a RTI Act, a public authority has been defined as any authority, body or institute of self-government established by constitution, any other law made by the parliament, any other law made by state legislative, notification issued or order made by appropriate government, and includes first body owned and controlled or sustainably financed non-government organization. So as argued in report of high level commission on CSR responsibility in 2018, the rationale behind allowing companies to use CSR amount for capital creation or acquisition is to encourage sustainable and effective initiatives. So the idea is not to limit CSR activity to revenue expenditure. Instead, it can also be used as capital asset that would yield further economic benefits. So the genesis comes from high level committee report. Government felt that the overall intent of legislation is to work for public good. But there were companies who were saying that they were doing CSR, but where they were creating assets in their books, which means you are creating asset for enduring benefit, which could be appreciated. So, for example, you are running a school program as a part of CSR for acquiring land and building. Then NGO running school, but building is sitting in the books of the company and getting appreciated. So, for another example is like a mobile healthcare van running for a good health care of the public in your books. But the overall intent of the legislation is to work for public good. This was clear indication of high level committee report that implemented in rules also. So practically it means that starting from 22nd January, that's where rule have got notified and implemented. All companies which have kept assets in their books, they need to transfer that out. The first, for example, panchayat or any group. So last existing capital asset is to be transferred within 180 plus 90 days from the notified date. That is January 21. So any capital asset created by the company prior to the commencement of the amendment rule shall within a period of 180 days from such commencement comply with the requirement of this rule. which may be extended by further period of not more than 90 days with the approval of the board based on reasonable justification. So you have to identify and transfer the asset in maximum time of 180 plus 90 days, and going forward, it would be too important for the board or the CSR committee to really look forward that if any asset is created, then ownership needs to be with each of the bodies and you may be the custodian. Next comes the CSR committee. As we know that every company which falls under section 135(1) says that a net worth of more than or equal to 500 crores, turnover of more than 1000 crores, or net profit of 5 crores during the financial year shall constitute a CSR committee of the board consisting of 3 or more directors, out of which at least one director shall be independent director. So before the amendments, it was during 3 preceding financial year. Now it was during any financial year. So there was a relaxation in section 135(9) that the amount to be spent by the company does not exceed 50 lakh, and the requirement for the constitution of CSR committee shall not be applicable, and the functions of such committee provided under this section shall in such cases be discharged by the board of director of such company. So, but if the company or the committee is formed, then the board has to give the power to alter the annual action plan in the accordance with CSR committee recommendation based on reasonable justification. Then, when compared to the original provision on CSR committee and the CSR Rule 14, the new rules appear quite detailed. So the earlier Rule 5 of CSR Policy Rule 14 vaguely mentioned instituting transparent monitoring mechanism for CSR implementation without specific its requirement. So the new rules made the process easier by laying down what all needs to be necessarily be included by the company in its action plan, and further functions of such committee shall be discharged by board of directors. So pursuant to new rules, the CSR committee has been given the task of formulating, recommending to the board an action plan in pursuance of its CSR policy. So the aforesaid plan shall include the following: the list of CSR project to be undertaken in Schedule 7 of the Companies Act. Second, the manner of execution of such project. Third, modalities of utilization of funds and implementation schedules. Fourth, monitoring and reporting mechanism of the project. And fifth is details of need and impact assessment, if any, for the project undertaken. This was all about CSR committees. Then next comes implementing partners. So implementing partners is a welcome change in this amendment rules, where mandatory registration is with the central government. So it was in the draft rule also to make this as regulatory concern, but as for now, they have required to do registration. Maybe in future they may change whatever, but now every implementing partner has to register themselves with NCA, with IT authorities also. And for that, form CSR1 is to be filed electronically and submitted to the registrar of the company. So Rule 42B mandates that form CSR1 shall be signed, submitted electronically by the entity on MCA portal, and shall be verified digitally by a CA in practice or CS in practice or a cost accountant in practice. So on submission of form CSR1 on portal, a unique CSR registration number shall be generated by the system automatically. The CSR registration number of the implementing partners has to be disclosed in Annexure 2. What is Annexure 2? Is Annexure 2 to be shown in the board's report. So the Form 1 is to be termed as form for registration of entities for undertaking CSR activities. So the form mainly constitutes of two parts. First part is relating to the information about the entities who intend to undertake CSR activities. And second part of form CSR 1 is certification by the practicing profession. Now, the fifth point is not required for implementing partners of the project approved prior to 1/4/2021. So if it's ongoing project, this is not required. It is just for not ongoing project. Not ongoing project, if it is before 1/4/21, then it's fine. But for ongoing project, it is continuing from 1/4/21, then it doesn't require. Only the new project which is undertaken after 1/4/21 has to register themselves as implementing partners. The last point is implementing partner has to have registration under 12A and 80G of the Income Tax Act. So therefore, it seems that only ongoing projects may be carried out by unregistered implementing agencies. So there is some consensus that CSR expenditure will not qualify for tax purposes. Then why are we bringing 12A and 80G mandatory to register of the companies? There are two reasons for this requirement. The first one is because 12A and 80G registered organization is better monitored by authorities and they have all the filings done. So from 2021, all old charities organization who is registered in the 12A and 80G will require re-registration. So now they have made better control and monitoring of this organizations. The second possible reason for this re-registration is last certain years, lot of non-profit organization who has come forward and said that we would become the implementing partners. So the government wants them to plunge into this forte. So there is possible reason why they require a set of companies which are registered and may get list from the MPA and they can become the implementing partners. So the entity has to file Form 1 electronically with the registrar, and this provision is made applicable with effect from 1st April 21. So the implementing partners having mandatory registration with the central government having 12A and 80G registration. So the next change was increase in internal control in the rules. So it might be a kind of new terminology for people working in CSR domain space, but you know some of the things that are said brings this kind to the fore. So the first is the board has to satisfy that CSR fund is used for the purpose and manner approved by it. Then second comes the CFO or a person responsible for financial management to certify CSR fund utilized for the manner and purpose approved by the board. Here, all things are very clearly point out a kind of high rigor in terms of compliance. And you know, this kind of recommendation and CFO certifying definitely requires a high maturity in terms of internal control. So what would be your input for a company designing a robust internal control to look into the design perspective? So one thing that stands out is CFO certifying companies. What we generally see, and it's varied towards company, a lot of CSR initiatives are carried out by the HR admin in many companies. So it could be a finance, but one thing which enforces the definition now is the CFO certifying should now enforce that everything is complying with section 135, and the new venture which comes out wants details of amount spent, unspent, implementing, agency part, assets, etc. So a lot of rigor will go into it. And as a CFO, if he's certifying someone from the team or internal audit team, also is to ensure that there is proper internal control in this. So CFO certifying, it will see from internal financial perspective that, for example, guidelines are set. What qualifies as CSR activity, make a checker kind of thing would be done by the team. Then they would do education to their team about the CSR rules, and then they would check it. And also section 135 is properly done or not. So the team would ensure everything as their own CFO has to certify. So a robust process should be ensured for what kind of sampling, impact study. You have to check on financial check also and a quality check also. So everything would be taken care by the internal team itself. Then also comes board has to monitor implementation of ongoing project with respect to approved timeliness and year-wise allocation. Then the new disclosure templates come, and the new disclosure templates was applicable from financial year 2021. So excess CSR spend carry forward, the new details which are to be disclosed are like excess CSR spend carry forward and set off, surplus arising out of CSR project, unspent CSR amount transfer to CSR account, and or Schedule 7, separate disclosure for ongoing projects and other than ongoing projects. Details of capital asset created, acquired, and the disclosure on website will be the composition of CSR committee, CSR policy, projects approved on ongoing basis. This was the definition which was included in increase in internal control. The next comes as impact assessment. For impact assessment, two things are to be kept in mind. That is aggregate spending, and second, spending in particular project. So the companies cannot just spend the amount and they have to see the social impact for the project on the society. So the first, impact assessment is mandatory, and impact assessment expenditure is to be limited by 2 to 5% of the CSR expenditure of 5 million, whichever is less. So here, three things need to be checked. The first is the company with average CSR obligation of 10 crores or more in immediate 3 preceding financial year shall take impact assessment through independent agency. This is as per the new rules which was added in Rule 83. Then second comes impact assessment to be taken for CSR project with outlay of 1 crore or more. And impact assessment to be undertaken for projects completely not less than 1 year before undertaking the impact study. So the impact assessment reports to be placed before the board, details and report of impact assessment undertaken and amount spent on the same has to be disclosed in the annual report on the CSR. So that doesn't mean that impact asset for other projects may not be done. So if you have a claim expenses for impact assets to be done and claim CSR expenditure, for it has to trigger the 3 points. So thus, after the notification of the new rules, the company qualifying the mentioned threshold shall be mandatorily required to carry out impact assessment of their CSR contribution. So it is hoped that such a requirement will result in more meaningful contribution by the companies towards the society. So there is, however, scope for clarity with respect to provision allowing companies to claim 5% of the CSR expenditure for impact assessment. So prima facie, it gives an understanding that such company has the option to claim 10% of the total CSR expenditure, 5% for administration overhead, and 5% for impact assessment. So although the same has not been explicitly mentioned in clear terms in our rules, a statement from government in this behalf can remove this ambiguity. So earlier it was ambiguity, now the definition is very clear that the expenses by the company itself, which is contribution to NGO. So NGO you may have taken for implementing the direct project expenses or project over. Now let's understand why they have put international organization in the new rules. So in 2021 amendment introduces a new term, international organization, defined under section 2G to refer to an organization notified by central government. As such, under section 3 of United Nations Privileges and Immunities Act 1947, to which provision to the schedule of the Act applies. So the High Level Committee on Social CSR 2018, headed by Injeti Srinivas, has recommended the introduction of international organization in India's CSR regime. So the recommendation has been duly incorporated, pursuant to which companies are allowed to take help of the international organization in designing, monitoring, and evaluating their CSR projects and in assisting them with capacity building of their personnel, which is also defined in the rules, Rule 4.3 of the new rules. So it is to be noted that the draft rule also proposed engagement of international organizations with respect to implementation of CSR project, subject to prior government approval, but the same has not been notified in the new rules. Now comes the penalty clause. Penalty clause is very important because now it has become mandatory, and to make it mandatory, they have created a penalty clause. If penalty clause in case of a company fails to disclose unspent amount in annual report of the CSR or transfer unspent amount into the fund specified in Schedule 7 within specified period and transfer unspent amount relating to ongoing project into unspent CSR account within specified time and transfer amount remaining utilized in unspent CSR account after 3 years into funds specified in Schedule 7 within specified period, a company in default shall be liable to a penalty a company in default shall be liable to a penalty of lower of the following amount. That is, first, twice the amount required to be transferred by the company to the fund specified in Schedule 7, unspent corporate social responsibility account, 1 crore rupees, or every officer of the company in default shall be liable to penalty lower of the following amount: 1/10 of the money required to be transferred by the company, or 2 lakh rupees, whichever is less. Now let's move on to the accounting part. So what is financial accounting? How should be accounting in the books of accounts? We are here to see how accounting is to be done in CSR expenditure. So for knowing what should be accounting, we should look into 135 section of the Companies Act. The amount of contribution made towards CSR would be generally be treated as an expense and charged with the statement of profit and loss. So unless it gives rise to an asset, according to the guidance note on CSR, asset would be recognized on basis of an evaluation of control over the asset and accrual of future economic benefit to the company. So Section 135(5), the board of every eligible company shall ensure that the company spends in every financial year at least 2% of the average net profit of the companies made during the 3 immediate financial year in pursuance of CSR policy. And if in case it has not accomplished 3 years of its incorporation, then such number of years. So Section 135(5) provides that the company shall give preference to the local area around it where it operates for spending the amount earmarked for CSR activities. So this is clarified in General Circular of 6 of 2018, dated 28th May 2018. So, what should be accounting in certain cases, like for example, if the CSR is contributed received by various projects or return on unspent amount, accumulation of unspent amount, or expenditure out of accumulated unspent amount? Let's see one by one in detail. The first is CSR contribution received for various projects. So, if the third party or company itself is receiving contribution from different companies for different projects, then the amount should be identified project wise, and receipt as well as amount spent corresponding to the project should be marked and reflected separately. So both the contribution and expenditure should be charged to income and expenditure account to the third part, and fixed asset acquired should be taken to the balance sheet to the third part. Now, accounting in the case of uh, return of unspent amount. The CSR donation received by the third party must be applied for charitable purposes within a specified period as per project program in CSR policy. In case the the donation are not utilized within the specified period during the year, the same may either be returned to the donor or same should be utilized as specified by the donor company. Then comes accumulation of unspent amount. So in case the amount required to be spent on project remains unspent at the end of the year, then the entity needs to accumulate the balance amount to be utilized in future period. So such unspent amount at the end of the year would be carried forward to the next year, and requirement formalities, compliances should be done. So if the entity is registered under 12A, then the charity entity needs to e-file Form 10 specifying the purpose of accumulation before the filing of return of income. Then comes last, expenditure out of accumulated unspent amount. So where the required compliances are made under the Income Tax Act, the accumulation for 5 years is treated as application of year income in the year of accumulation under the Income Tax Act. So in subsequent years, when the expenditure is made out of the accumulated fund, the accounting entry would be CSR project account debit to bank. So the amount spent out of the accumulated fund would not be charged to income and expenditure, but would be charged reduced from the fund created from the asset or liability. Now comes the recognition and measurement of the CSR expenditure part. The accounting relating to CSR may take shapes in various scenarios. For example, if it is spent on its own or the spent amount or contributed to any fund, then it has to be directly charged to an expense to the statement of profit. Through registered entity, it has to be charged to expense, and if it is unspent amount, then it would be as per section 135 or 135(6), which we have already discussed. For accounting purpose, the above scenario can be classified and said whether it is from the company's perspective or from the third party perspective. Then comes the recognition part in case of income surplus earned from CSR projects. So any surplus arising from CSR activities shall not be a part of business profit. Such surplus shall be used within 6 months from the expiry of the financial year, and it can be plunged back to the same project or transferred to the unspent account or spent in pursuance to CSR policy for the action plan of the society. Then comes CSR expenditure wrongfully claimed as product or service cost and not shown separately as CSR. So it is recognized as a not cost profit item and as per declared in CSR policy of the company and reflected in profit recognition statement. And any eligible expenditure, it is whether a particular expenditure spent on CSR will be allowed under Income Tax Act for the company will depend upon nature of expenditure itself. So revenue accounting of revenue expenditure, it is same as we have discussed. Is a revenue expenditure if the company has incurred expenditure on activity such as specified Schedule 7 of the Companies Act, and if CSR expenditure is relating to business of the entity, then such expenditure should be treated as expense in profit and loss. And in case a company has received grant, then it should be net off. And the last point is income earned during the course of conduct of CSR activity. It is any surplus arising from CSR activity is not arising from transaction with its owner. It would be considered income for accounting purposes. Now moving on to the last part, that is auditing part, which is required by every chartered accountant. Maybe it is from the company's perspective, you are the auditor of the company or you are the auditor of the third party of the NGO. What does a chartered accountant in practice or who is in the company has to look at? So whether when the government has brought in an amendment in the Companies Act providing 3 years of jail violating CSR norms, the government is, however, reconsidering its decision and make it as a civil offense. So the inclusion of details of CSR spending in financial statement and enhancement of disclosure is likely to be made in CSR framework transparent and robust. So there is a huge spending of CSR, so audit is very important. So what are the provisions which are required or requirement of audit of CSR activity seems not to be mandatory as per Companies Act 13. So however, various provisions of the company's policy rules require monitoring and reporting mechanism. So which are these provisions? They are Rule 4, 5, 6 for the CSR Rule 24. What does Rule 4 say? The sub-rule 2 of Rule 4 specifies that provided that if the company or the board of the company decides to undertake its CSR activities through a company established in the Section 8 of the Act or registered trust or a registered society other than those specified in the sub-rule, Such company or trust or society shall have an established track record of 3 years in undertaking similar projects or program, and the company has specified the project or program to be undertaken. Modalities of utilization of funds of such project are programs that are monitored, and reporting mechanism has to be done. Then Rule 5 of Sub-Rule 2 of Rule 5 said that the CSR committee shall institute a transparent monitoring mechanism for implementation of CSR project or program or activity undertaken by the company. And the last, Rule 6, Sub-Rule 1B said that the CSR policy of the company shall inter alia include monitoring process of such project or program. So here monitoring of CSR activities and its reporting is mandatory as per Companies Rule 24. So also it is the responsibility of the company through its CSR committee to monitor the funds of the company which are to be utilized as per CSR policy of the company. So in case where a company is complying with the CSR obligation by merely making contribution or donation, which is specifically allowed by Schedule 7 of the Act, there would not be any requirement of obtaining any report of such donations made. So now let's take a responsibility of auditors. What are the responsibility of auditors? First, in case a company undertakes CSR activity by itself. Second, wherever company undertakes CSR activity through third party. So wherever a company undertakes CSR activity by itself, the auditor of the company should ensure that the activity or project undertaken is within the purview of Schedule 7 of the Act. If mere contribution donation is given, then the same should be specified and allowed as per Schedule 7 of the Act. Separate disclosure of expenditure on CSR activity has to be made in Schedule 3 of the Act. Then the expenditure on the project, which is incurred, has to be as per Companies Rule 2014. Then comes the company has compiled with applicable accounting standards in accounting, recognition, and disclosure relating to CSR spend. Also, here they have to check that they have compiled with the standards on auditing like SA 250, 720 revised. What is SA 250? It is consideration on law and regulation in an audit of financial statements. And SA 720, it's auditor's responsibility relating to other information. The auditor has to compile with the guidance note of auditing of expenditure, and also to see whether on its website and its CSR report, the undertaking has been accounted for its policy area, has described its business models, and has disclosed the use of any non-financial key performance indication. So auditor also has to check whether CSR report covers the same period of annual report, specify the period covered by the annual report. Whether the parent company has prepared a consolidated CSR report that complies with the requirement as publishing a report that addresses CSR, or a parent company which has prepared UNGRI report that complies with relevant requirement of its country. The next part comes the auditor that seeing practice of the third party before issuing of the independent practitioner report on utilization of fund. In this case, the third party has spent the fund on CSR activity as per Section 135 of the Act. Read with Schedule 7 of the Act and relating regulations. So here the CA has to verify CSR spent as per guidance note on audit of expenses. And also, the utilization of CSR fund report is issued in accordance with the guidance note of the report or certification of special purpose issued by the Institute of Chartered Accountants. So what is utilization certificate? So the companies should obtain a CA or an auditor's report on utilization of CSR fund if CSR activity is done through third party. So initially, every funding agencies, including CSR corporates, asked for utilization certificate to track their project expenses, which may be audited or unaudited. So generally, unaudited utilization certificate is sent to funding agency with the signature of the head of the organization. So the audited utilization certificate asked yearly once or at end of the project. What was the problem? The problem was that there was no uniform format of the utilization certificate defined in FCRA or income tax. So generally either CA gives utilization certificate as per his format or sometimes funding agency provides specific format for it. Because of this non-uniform format, problems were faced by the statutory auditors of the corporates. He has to specify all the expenditures spent by the company under 135, and so he needs to compile all such expenditure of the company from CSR fund given to various small NGOs organization. So, but the utilization certificate received from small NGOs were in different format. Since all format of utilization certificate was different, it was very difficult for the auditors to compile with the utilization certificate. So, to solve the problem, ICI gave a specific format to the CSR fund, and the specific format was called as Independent Practitioner Report on Utilization. So the format of utilization of a report is being issued after duly vetted by the Auditing and Assurance Standard Board of ICI, wherever a company is required to comply with CSR regulation under Section 135 of the Companies Act 13. So it may undertake the CSR activity either by the company or through the third party. So now the Institute of Chartered Accountants of India said that the company should obtain a CA report on utilization of CSR fund. And if CSR activity is done through third party, in an advisory issued by the members of ICA, the company to whom CSR provisions under Companies Act 13 said that whenever the company undertakes the CSR activity through a third party NGO, it is advised that all companies should obtain an independent practitioner report on utilization of such CSR fund from the auditors or CA in practice of the third party NGO to whom the fund are given by the company for implementing CSR activities. So in such case, the auditor or the CA in practice of the third party or NGO is advised that they should submit the independence practitioner report on utilization of CSR. As we all know that UDIN has to be made, so UDIN is also mandatory for grant utilization certificates, and also like certificate for fund grant utilization for charitable trust, institutions, utilization for NGOs, for statutory auditors under FEMA, FCRA, other laws. So UDIN is also required for independence practitioner report. Now, moving ahead with the next part is Caro. So, the government is providing various relief measures and relaxation in order to boost businesses and the economy. So, in the same context, the MCA had postponed the applicability of Caro reporting 2020 from financial year 1920 to financial year 2020. And now, MCA wide order dated 17th December 2020 has changed the applicability date of companies Caro 2020 to financial year commencing on or after 1st April 2021. So the Caro 2020, which was applicable for 21-22, Caro 16 will continue to be applicable for financial year 2021. And Caro had a list of reporting requirements that were needed for auditors who audits the company or businesses. MCA has issued companies auditors report order 2020 to enhance the scope of the audit. So the MCA in consultation with the NAFRA, that's the National Financial Reporting Authority, released Caro 2020. It lists out all subject matters on which applicable companies are mandatory required to report. So there were a list of amendments in Caro 2020, and there was no alteration in applicability of Caro, which Caro comprises of 21 clauses against 16 clauses in 2016. So 7 new clauses were entered and 1 new clause was merged with other and 1 was deleted. Recently, the MCA notified the company's rule and the auditor had to give their opinion on CSR in reference to section 135(5) and 135(6) of the Companies Act. So this two section pertain to transferring unspent CSR amount to PM National Relief Fund. So what was the newly entered provision? That was provision 20, reporting on CSR compliance, where you had to write the funds transferred by the company as per 135(5), 135(6), other than those designated to ongoing CSR project must be specified in the report. So let's review it again. What is section 135(5)? 135(5) says that if the unspent amount does not relate to an ongoing CSR project, such unspent amount should be directly transferred to the fund mentioned in Schedule 7 of the Act within 6 months from the end of the relevant financial year. Second, what does section 135(6) says? That any unspent amount from the total allocated CSR remains pursuant to an ongoing CSR project in accordance to its CSR policy, then the company is then required to transfer such unspent amount to a special amount called unspent corporate social responsibility account within a period of 30 days from the end of the financial. So the amount that has been carried forward to the unspent CSR account must be spent in consonance with the CSR policy within the stipulated period of 3 financial from the date of transfer. So on failure to do the same, the company should transfer this unspent amount to the fund specified under Schedule 7 of the Act. So in a nutshell, the new clause has been inserted in Caro 2020, which requires the auditor to report on whether unspent CSR amount has to be transferred to a fund specified under Schedule 7 or a special designated bank. So what are the duties of the auditors for disclosure to Caro? In case of only CSR. So the auditors need to evaluate the applicability to section 135 to the company. First, the auditor needs to obtain first board approval to CSR policy as recommended by CSR committee. Second, agenda and minutes of meetings of CSR committee. Then the working of the amount required to be spent under section 135 of the act, retaining the calculation of average net profit as per section 198 with read with 197. Then the auditor is required to obtain confirmation from management and review whether the CSR activities undertaken with the company are in accordance with the Schedule 7 of the Act. So the auditor should also verify the amount spent in respect of ongoing project with the supportings such as expenditure receipts, bank statements, etc. So in case of unspent amount, the auditor should verify the bank account to ensure whether it is earmarked for CSR activity, open for the respective financial year only, and called as unspent CSR account. So in addition to the proceedings till now, we decided the auditor should also consider the provision of the CSR Rule 2014 while reporting on unspent amount under the clause. So the auditor may also consider various representation from the management regarding compliance of requirement of section 113. So in case the company has not transferred the unspent amount in respect of ongoing projects to a special account as specified under 135(6) of the Act within the time limits, the auditor should ascertain certain details at the part of its working paper. What kind of details? This. The auditor should bifurcate the amount in this kind of format. Relevant financial year, amount identified for spending on corporate activities, unspent amount, amount transfer to special account under 135(6), due date, actual date of transfer, and numbers of days. Then also, after this working, further, the auditor should report compliance with this clause as in respect of ongoing project. In respect of ongoing project, the company has transferred unspent amount to special account within periods of 30 days from the end of the financial year in compliance with section 135(6) of the SEDA, except in respect of the following. The first comes is financial year. Second, amount unspent on CSR activities for ongoing project. Amount transferred to specified account within 30 days from the end of financial year. Amount transferred with the due date, that is specify the date. The auditor should also report the non-compliance, if any, in respect of earlier year in the format given above. Okay. The next comes the auditor. The auditor should appropriately bring out this fact when reporting in the clause, and the auditor may take the following comment. Like the companies has not transferred, you can give a qualified report, and the qualified report would also specify this line that the company has not transferred the amount remaining unspent in the respect of ongoing project to a special account till the date of award. So, however, the time period for such transfer, that is 30 days from the end of financial year, as specified in 135(6) of the Act, has not elapsed in the date of award. Yeah, this can be a comment on your part to save yourself. So in this situation where the time period specified under 135(6) is not yet elapsed at the time of issue of the auditor's report, the auditor should report under this clause in this fashion. Now there were amendments to Companies Act 2013 and Schedule 3 also. So initially they were made, now they have made changes, and now they have included disclosure of CSR activities like where a company is covered under 135 of that. amount required to be spent by the company, amount expenditure incurred, shortfall, total of previous year shortfall, reason for shortfall, nature of CSR activity, details of relating parties, and if a provision is made with respect to a liability incurred by entering into a contractual obligation, the movement in the provision during the year should be shown separately. So, such in detail, the CSR activity has to be disclosed in Schedule 3 also. It is means the disclosure in our financial statement has been increasing, and Schedule 3 has also inculcated CSR disclosures. So now let's look into how to present and disclose CSR expenditure in the financial statements. That is the reporting aspects. So presentation and disclosure in financial statement of CSR expenditure. So unless CSR reporting practices are standardized, it is not possible to provide stakeholders with confidence that the underlying CSR disclosures are both reliable and comparable. So, this proposed CSR reporting standards should therefore be specified in sufficient detail, similar to IFRS, to avoid inconsistent interpretation and application. So, also they require disclosure in board's report. So, it is mandatory for every company to forward to its member along with the annual financial statement of the boards of director report. The report of board of directors should be attached to the balance sheet and laid before it the AG. The director's report is intended to explain to shareholders the overall financial position of the company and its operation. So the board's report, as per section 135(2), discloses composition of CSR committee. Board of directors of the company shall mandatory disclose the composition of CSR policy, projects which are approved by the board on its website for public access, and the policy developed and implemented by the company on CSR initiatives along with annual report of CSR undertaken during the year. So, making the company disclose their CSR activities and contribution to society is important to help their public make informed decisions. So, the investors these days are becoming socially aware and want to engage with companies that take positive steps for the development of the society. So the concept of CSR is based on principle of comply or explain. So now there is a shift to comply or pay penalty. So it may also happen that the company is incurring losses, but it may still satisfy other conditions specified under Section 135 of the Act and become liable to comply with the provisions of Section 135 and the Company Rule 2014. But since there are profits, the company may not spend any amount and still it will have to disclose the reason for not spending any amount in the board's report. So if the company fails to spend, the board shall in its report specify the reason for not spending the amount, and in case it does not disclose the reason for not spending, the company shall be punishable with fine. So a detailed disclosure has to be mentioned as in the cash flow statements also to provide of the relating transactions such as contribution to the trust controlled by the company in relation to CS. So basically, let me show you what kind of reporting they require in its director's report of CSR activity. So let me show you how they want to show. This is the format in which the CSR activities are included in the board report. This first I am showing you prior to 1420, and then we will look into 1420 after 1420. First, you have to show brief outline of the company's CSR policy, then the composition of CSR committee, average net profit, prescribed CSR expenditure, that is 2%, details of CSR spend. And in this fashion, the outlay has to be shown. And finally, you have to give details of implementing agency. In company, if we fail to spend 2%, the reason for it, a responsibility statement, and finally, it has to signed by the CEO, chairperson, and in case of foreign company by section 381. Then comes the format for the annual report on CSR to be included in board report after 1/4/2020. Brief outline of CSR policy, composition, web link, details of impact assessment, then details of amount available to set off in the tabular form. Then comes average net profit, 2% surplus. Then amounts unspent. Then details of CSR spend on ongoing projects. Then CSR spend on other than ongoing projects. Then amount spent in administration, impact assessment, and total. Then as the new rules, excess amount has to be set off. They also require excess amount thing. The first thing is 2% average total spend excess. Fourth is surplus, and fifth is average set off for succeeding financial. Then comes amount of unspent CSR amount for preceding 3 financial year. They require each and every details. Then comes details of CSR amount spent. Then here they give a capital asset creation. In case you have reason for failed expenses, then undersigned by the CEO, chairman, and person specified under 3D, that is a form.
Hello.
Yes, ma'am.
No, actually, I'm coordinator. It's done.
No, I is the session till 7 or 7:30?
Okay, you want to extend this session?
No, for just 2 or 3 minutes, I'll just show you the annexure and then
Okay, no problem. This is fine.
in this fashion, this is the draft format of notes to accounts. All the requirement, gross amount, required amount by the board, spend, details of relating transaction, amendment which are made in 135 file, you required to give details in detail. And finally, here provision disclosure schedule 3. And where CSR expenditure being goods is incurred in kind, the same should be measured as per AS2. So this was the format in which Board of Directors report has to be shown. Second, they have to show in notes to accounts. So this is the format in which CSR expenditure are being required to be showcased in our financial report. So that's done from my end to present for the CSR thing. Pooja,
Yes, I'm listening.
yeah. So I have completed from my end. So there are
Okay.
certain questions in the question and answer. So let's first take that and then complete the session.
Okay.
So first, the question is, can a company give CSR to charitable trust against amount already utilized by that trust for specific purpose? So yes, the company can give. A company can provide CSR to a charitable trust to reimburse expenses already incurred by the trust for a specific purpose, already incurred by the trust for a specific purpose, provided that the trust activity is aligned with the company's CSR policy. However, it is crucial to ensure that the trust utilization of fund is transparent and aligns with company's CSR objective. The second question is, penalty by officer is to be borne personally or by the company can fund. So penalty by the officer is basically to be borne personally, because no company will support the person in default, and the company would not, if the company has shifted the problem from itself to the person in default, then I don't think that the company would bear the penalty cost. But in case if the company makes the person liable, and the company has a long lasting relationship with that employee, then in that case it is the totally at the discretion of the company to bear or not bear, and that can be that decision can be taken up by the board of directors. Then comes the third question, account to be opened yearly or a cumulative account is okay in banks for unspent amount. I think there should be only one account. Once in the life of the company, it should be open and it can be used year on year, and just the accounting has to be done properly so that we can understand whether uh, whether the proper utilization of unspent amount is being done or not. So for any CSR unspent relating to ongoing projects, we create an unspent account, but this account is specifically to each financial year and not each project. So the funds in the account must be utilized for CSR activity within 3 financial years. So yearly account opening would be like for a specific project would be fine, but I think that same account can be utilized subsequent years also. Then the question is there any master draft CSR policy which can be act as guidance for company? Yes, we have a CSR draft rules, not the policy, but the MCA has come out with the CSR rules. So and there cannot be any master draft for a CSR policy, because company to company depends on what kind of projects they want to undertake, what kind of policy they want to use, what areas they want to project, and only you can take guidelines and rules from the CSR Act 13 and rules which are amended, but they cannot be a perfect set of policies, because the locations and everything has to be decided by the company itself, and so it changes from company to company, so it all depends from the CSR committee and the boards of directors. Then comes CSR compliance, section 135, CSR applicability triggered due to net profit exceeding 5 crores in financial year 24-25. That is 5.38 crores profit in financial year 21-22, 22-23, and financial year 23-24 is rupees 11.49 crores, 6.23 crores and 3.89 crores respectively. So calculate liability as well. Liability to be booked in financial year 23, 24, 24, 25, 25, 26. Spend or transferred as per prescribed time. Disclosure in board report and audit report is mandatory. Yes, disclosure in board report is mandatory whether you spend or not spend the amount, because there is penalty, and in the annexure too we have a positive of time, or else would have shown you that in director's report there is a column. Now we have seen the board's report annexure in the last part, they have said that what was the reason for not spending, or what is the reason for spending more. So they want reasons for everyone, so disclosure has to be shown in our board's report, so it is mandated. Then comes extension to the first question, that the trust has spent 1 crore to build a school, and the CSR donates the fund in financial year 21-22 to reimburse the trust as it complies under Schedule 7 and the company's CSR policy. Will that work? I think the expenditure, so you need to ask that whether in 1 year the expenditure is made by the NGO, and in the next year you are reimbursing them. So basically it is between the company and the NGO, the MOU which is signed by them. If it is good on the part of NGO, if it is good on the part of NGO, then it is totally fine. So, but the accounting has to be done properly in the books of company as well as in the books of NGO. So the next question is there any restriction of related parties like companies director being implementing agency governing board? Yes, of course. There are restrictions on relating party acting as implementing agency for CSR activities. So while directors, shareholders, or entities established by the company can be involved in CSR implementation, there are provisions to prevent misuse of funds and ensure transparency. So, Section 188 of the Companies Act regulates relating party transactions. So, that also requires prior approval from the audit committee. So, prior approval of audit committee, disclosure in the board report, and justification for that transaction. All needs to be disclosed, taken board's resolution. Now, going on to the next question, is CSR policy of a company a public document and needs to be published somewhere? Yes, a company's CSR policy is generally considered as public information and is required to be published on the company's website. So, according to some guidelines, additionally, it should be disclosed in company's annual report also. So there would be a link of a PDF has to be uploaded through a link which is given in the annual report as well as the director's report, through which you can go to and find what is the policy of the company. So I think I have answered all the questions that was done in the question and answer, and there is nothing in the chat box itself. So now, thank you so much, WIRC, for giving me the opportunity to give my insights on CSR, and I hope I would be fair enough in giving you what all clarifications you have required from my session.
Thank you so much, Charmi. It's my proud privilege to propose a hearty vote of thanks for the speaker of the day, Miss Charmi Shah. Your insight on the CSR provision and accounting taxation related information were truly enlightened. I'm sure the audience will greatly benefited for the experience and information you shared and the various pointers to be presented towards with this. The audience carry out vote of thanks with the warm applause.
Thank you so much.
Welcome, Charmin. Thank you so much, Charmin. Thanks.
Thank you.
Bye.